All right, good afternoon, everybody. How are we doing today? Well, we're doing something a little different today. You normally hear from us on Thursdays, but we're doing a webinar today and then another one tomorrow, kind of back to back here. And we're going to talk a little bit about Nadex Spreads. We've been talking about binaries particular over the last couple months, and we want to give a little love to the other side here and talk about Nadex Spreads. So good morning, Tammy. Good morning, everybody. Can I get a quick audio video check? Let me know that you can hear me speaking and that you can see my screen here and see our title page. Perfect, Leonard. Thank you very much. Okay, let's get our disclosures knocked out and let's get moving here. We've got a lot of ground to cover. Now, you know, for some of you guys, this might be elementary. You might have heard this webinar before, or you might have been through some training before about Nadex Spreads. But in these webinars, we kind of cycle back through every so often and kind of go back to the basics for a couple reasons. For one, we've got new people that have come into the group, new people that are just getting familiar with Nadex, trying to learn who and what Nadex is. But also what I found is even if people have been on a basics webinar with me 2 or 3 times, they'll come back as, man, I didn't catch that part. That makes all the difference for me. I tried binary, or I tried spreads, and I thought I had all the pieces, but I was missing that one part of it. And now kind of a light bulb goes off, and it's always good, to refresh on the basics here. So again, for some of you, this might be very elementary, been through before. For some of you, this might be your first time ever hearing about spreads. And what we're going to do is just kind of walk, hold you by the hand and walk you through like you've never heard of a Nadex spread before. You don't know what it is. We're going to cover the basics here today. Okay. So let's get our disclosures knocked out so we can move forward here. As always, trading futures, options, or any financial instrument involves risk. May not be suitable for every investor. Any trading decision is your sole responsibility. Past performance not indicative of future results. Okay. Now, one thing, guys, if we're on a webinar and you see me pull up the Nadex platform and enter an order or place an order, that's in no way trading advice. That's in no way a trade recommendation. That's simply me just trying to help you visualize what it is that I'm trying to teach you that day, or help you understand how to actually use the Nadex platform and the ticket entries and so on. So just want to clarify that for you there. Okay. So if you are brand new to Nadex, make sure you hop on over to nadex.com and you can go through some of these top tabs here and get some good information here about the 2 different, basically Nadex offers 2 different products. They offer binary options and spread options. Okay, and you can go through there and get some information about both of those. Then here under Learning Center, you've got some great resources here, some videos and ebooks, webinars like the one we're on now. If you go right here to webinars, this will show you some of the upcoming webinars. Okay, for example, today we're talking about the basics of spreads, just kind of the basics of how they work. Okay, tomorrow we're going to actually dig in a little deeper to making sure you truly understand the risk and reward with spreads, because that is one of the biggest misconceptions about spreads, is the risk and reward. And once you really understand that, it can really open your eyes of trading these things and how to trade them. Okay, but anyway, you can go through and get some, do the schedule here and see what the upcoming webinars are, the dates and times. Get registered for those. Once you're registered, you'll get reminder emails about those coming up. So right here, you can go and click upcoming webinars to only see the ones coming up. Or if you've missed some past webinars, or if you're new and you really want to dig into some free education, you can click on demand and just scroll down right here, and you can find me right here, John Skelton with Apex Investing Institute. And this will pull up all of the past webinars. All right, and this is just a library of just a wealth of information here, everything from the basics to top mistakes, strategies, different ways to trade. And this is all free to you guys. Nadex, I have to hand it to them. They do a great job of providing their members with a ton of free tools, ton of free education. So definitely take advantage of that, make the most of it. Speaking of free tools, if you go up here to trading platform, you go directly to the online platform. You know, you've got some mobile options here, but demo trading platform, Nadex will give you a free $25,000 demo account. And all you gotta do is fill out some quick info and hit open my practice account. And in just a couple moments, you will get a email from Nadex, and it'll give you a temporary password, which will allow you to log into your demo account. And let me just log into mine real quick here and show you. But it's a great place to get started, great place to get familiar with Nadex, practice any new strategies or systems, you know, make mistakes, work out the kinks in demo, not in your live account, right? If you're trying something new, try it in demo, make the mistakes, work out the kinks, get profitable and comfortable in demo, then move over to your live account. All right, so it's a great thing. I still use my demo account every day when I'm testing things out. Or maybe I'm, you know, trading binaries in a live account and I'm testing a spread in the demo, or vice versa. Okay, always trying new things and utilizing that demo account. By the way, when you log in for the first time to your demo account, like I said, they'll email you a temporary password. It might be some long, you know, password. Just go right up here to my account and then go right here to settings and then password. And that'll let you change the password to whatever you want it to be, easy to remember, okay? And by the way, you know, when you go in here into the Nadex platform, you know, you'll see everything over here, all the different options, indice binaries, indice spreads, forex binaries and spreads, commodity binaries and spreads. And what we're going to be talking about today is the spreads, okay? So that's where you get some more information there. Who am I? Like I said, my name is John Skelton. I'm with apexinvesting.com, and Nadex has us on to do these webinars for you. Like I said, to provide you with some free information, free education. You know, we're traders. We're an online education company. We've got over 25,000 members. You know, we've got live trade rooms and indicators and strategies. And we're here just to kind of help you understand who and what is Nadex, how are some ways that we trade the Nadex products, and give you some ideas how you can potentially, you know, implement them into your trading as well. I've been with Apex now for about 5 years as head of operations. I've got a background in banking and as a licensed stockbroker, and I'm a trader just like you. I trade Nadex almost every single day. Okay, so that's what we're here for. And I have to say, I am a huge fan of Nadex Spreads. You know, a lot of you are familiar with the binaries, and some of you haven't really gotten into the spreads. The spreads are one of my favorite things to trade, to be honest with you. So we're going to talk about that a little today. What is a Nadex spread? You know, why should you consider checking them out? How to use them? How do they work? And you know, you've heard me say this before. I used to call them box spreads because if you draw them on a chart, they kind of look like a box, okay? And I'm going to show you examples of what I mean. But basically, a Nadex spread, okay? And by the way, if you are familiar with Nadex binaries, okay, I want you to kind of forget everything you know about Nadex binaries because these spreads work completely different. All right, so that's the first thing you have to understand is they are very different, okay? They're not all or nothing. They're not 0 or 100 at expiration, okay? But I'm going to show you examples here. And the biggest thing you have to know up front as far as understanding the basics of a spread is that spreads have a top and a bottom, or what we call a floor and a ceiling, okay? In a spread, the price is driven by the underlying market. It's not driven by supply and demand. It's driven by the underlying market. And in forex, it moves in pips, and for futures, it moves in ticks, okay, which is the last digit quoted. And every digit is worth $1 per spread that's bought or sold. What do I mean by that? Well, I'm going to show you an example. But the great thing is, with Nadex, not just with Nadex spreads, but with all products, they're capped risk. You cannot lose more than you put up to get in that trade. Okay, your risk is the initial cost to enter that trade. You know, if you're trading certain other products on the, you know, the spot markets, and I mean, the market can just, you know, there's a flash crash against you and you could lose everything that's in your account. Okay, or you could lose everything in your account plus more and you owe the broker money, right? But with Nadex, you cannot lose more than you put up to get in the trade. You have known upfront capped risk before you ever press the button. And you can trade stock index, you know, products based off stock index futures, commodity futures, and cash forex. So how do they work? Okay, I'm going to give you a quick kind of example here for you to understand the basics. Well, like I said, every spread has a top and a bottom, or a ceiling and a floor. So just for example's sake here, so you can get an idea, let's just say that, you know, this happens to be the euro dollar. And let's say there's a floor of 1.2400 and a ceiling of 1.2500. Okay, again, just an example. So the spread is the difference between the floor and the ceiling. Okay, that's the box, as it were. Okay, and there's 100 pips in this particular spread example here. Now, don't get that confused with $100 like a binary of 0 or 100. Okay, so it moves in pips or ticks, which is the last digit quoted right here. See that in yellow? Okay, so 1.2500 or 1.2501 or 0203. That last digit quoted there, okay, is how it's quoted, and each pip is worth $1. Okay, so for example, if it said 2500 and that's where or if it said 2400 and I bought, well, and you know, then at expiration it said 2401, then I would have profited $1. If it said 2410, then I would have profited $10, right? Each pip is $1, okay? In this particular spread, there's 100 pips total, but it's not like a binary 0 or 100, okay? So let me kind of show you here. So with a spread having a top and bottom, floor and ceiling, like a box, okay? You're kind of confined inside that box and protected inside that box. All right, so let's look at an example and say that I was selling, okay? Meaning I wanted to go short, I thought the market was going down. Well, if I'm selling, saying the market's going down, if I'm wrong and the market goes up, I do not lose any money outside of the spread, okay? Meaning if I sold the spread right here, saying I want it to go down, okay, but it shot up, I only lose $1 a pip up to the ceiling. It could go another 200 pips against me and I don't lose anything, okay? I only can lose from where I get in to the top if I'm selling. So I can't lose additional money above the ceiling, okay? I also don't get stopped out, meaning just because the market hits the top of the ceiling, it doesn't just close my trade. It doesn't close out the spread. The spread is still open. And I'm fine with that. Why? Because I'm not losing anymore, right? So there's no reason for, you know, I'm not trying to close out of it because it's going against me, because I've hit my maximum level of loss. So if I'm right though, and the market does go down, okay, I can't lose additional money above the ceiling, but I also don't make additional money below the floor, okay? The top and bottom, the box, is my trading zone, as it were, okay? And you'll see as you dig into this, you can hop on over to the Nadex platform and you'll see, like if we go to spreads, let's look at the derivative of the Dow, for example, at the end of the day here. There's all kind of different spreads, right, with different floors and ceilings. This one is 26,700 to 27,100. Okay, that's a 400, you know, tick wide spread. See, there's all different floors and ceilings here. Okay, and there's spreads that, you know, expire in 2 hours, like this here. It opened up at 12 noon, expires at 2. This one, these at 1, expired at 3. I can click these. And again, notice there's different spreads with all kind of floors and ceilings. So based on what I think the market's going to do according to my strategy or system, I'm not just stuck with one spread, right? I've got different options there as far as, you know, where I want this box to be on my chart, as it were. Okay, so there's quite a few options there. So let's look at an example, okay? And let's just say that I sold up here and I sell at 24.90. So I'm selling, saying, you know, the market's going to go short. Okay. Well, what is my risk? So if I sell at 24.90 for the market to go down, but I'm wrong and the market goes up, what's the very most that I can lose? Because remember, I don't lose money above the ceiling, right? So I can only lose money up to 2,500. So yeah, Leonard, exactly, right? So, yep, Tammy, because the ceiling is 2,500. I don't lose anything above that. I sold at 24.90 right here. So 10 pips is my risk, right? That's my risk amount is 10 pips. Each pip is worth $1. Okay, there's 10 pips. So my max risk is 10 bucks. So if the market goes against me to 2,500, the most I can lose is 10 bucks. If it goes way up here to 2,600, 2,700, 2,800, it can go hundreds against me. Doesn't matter. The most I can risk or I can lose on this particular example is 10 bucks. Okay, that's powerful, right? That's powerful, because how many times have you gotten into a trade and you want to go short, but the market pops way up against you and knocks you out, and you lose money? And then what does it do? And now we're going to come your way. Happens, right? Well, remember what I also said here is I don't get stopped out. Just because it comes out here outside of the spread, I'm not sweating it, because I'm not going to lose anymore. I also know that the trade is still open if it hadn't expired yet, and it could come back into my spread, right? So it's very powerful, right? It makes trading not as stressful, where your heartbeat's not going crazy, right? If you get into a contract, you know, a spot type contract, that thing starts going against you and going against you, like your heart's beating, right? You're freaking out and you're stressing, like, should I get out? Should I get out? Well, in this particular example here, it's like, okay, well, it went against me and it's at 2,500. I've lost. Right now, I'm down the $10. I can't be down any more than that, no matter how far it goes against me. Like, that's it, right? But I know it's still open in case it wants to come back in. Okay, so there are, if I entered here at 24.90, okay, the floor is down here at 2,400. So I have 90 pips of potential profit, okay? Each pip is worth $1. So I have a potential profit of $90 maximum. Because remember, let's say I'm right and the market comes down and pulls up, comes down and hits there. Well, look, it kept going. Do I make any money from here? So I was right. But do I make money from here on down? Who can tell me, yes or no? So I sold up here, saying the market's going down. The market came down, came all the way down to the bottom, to my floor, and kept going. Exactly. Yeah, I don't make money past the floor, okay? I only can make money to the floor. So you see what I said, like a box? I think of them like a box, okay? Now, if the market hit here and came to the bottom of my floor and I'm not making any more money, but everything on my chart is telling me, hey, it's going to keep on rolling, what is something I could do? What's something that I possibly could do? Like, let's say I was in this spread right here, and I was buying, right? And the market got all the way, see, this is the floor and this is the ceiling. Say the market got all the way to my ceiling here of 26,725, and it kept going up. Look what's right above this, or at the top, or just above this, 26,725. What is this number right here? 26,725. So look, this is the ceiling of one spread, right? That's the top of a spread at 725. Then you got another spread where it's the bottom of the spread and it goes up another 100. Yeah, I could get into another one. You see that? Okay. So I have my caps and my limits, but if I think it's going to keep on rolling, I can just get into another one if that's available, if it's, you know, the one that I want. But you see that example right there where this spread goes from 625 to 725. That's the top, bottom, that's the top. Let's say I bought it and it reached the top and I think it's going to keep going. Well, look right up here, 725 to 825, goes up another 100. Okay, well, hop into that one, right? So yes, it limits your profit and loss within this box, but then just go into the next box if you want it. You're not limited, you have options, okay? So that's pretty powerful, okay? And it's $1 a tick. Now, remember I kept telling you, don't confuse this with binaries. Just because I'm giving you an example here of 100, don't think like a binary. If I sold right here at 24.90, okay? The market comes down to 24.50 and I close the trade. Well, my profit or loss is $1 per pip based on where I get in and where I get out. Make sense? So if I sold at 90 and I get out at 50, what's the difference there? Sold at 90, got out at 50. Well, that's 40 pips difference, right? And what? Each pip is worth $1. So what would my profit be? $40. Make sense? Or let's say I sold at 90 and it comes down to, and I get out at 20. Well, 90 down to 20 is 70 pips. Each pip is worth $1, so $70. You see the difference? This is not all or nothing at expiration binary. It's not 0 or 100 at expiration binary. It's mimicking the underlying market, as it were. As the market moves in certain ticks, you're following along with it, but at $1 a tick compared to where you get in and where you get out, with limits on each side. And your trade doesn't get closed out just because it hits one side or the other, right? And that's a good thing. Let me show you another example. So any questions on what we've talked about so far? We're gonna keep going, but any questions on this particular shot right here and this example of selling a spread? Make sense to everybody? Spreads really aren't that complicated once you kind of see them, right? And once you get your mind away from binaries and just think of trading the market, okay? All right, yep, perfect. So now let's look at a different example. Let's look at about buying a spread. Works the same way, just the opposite. Okay, a spread is still a box. It still has a top and a bottom. Okay, it still has a floor and a ceiling. So it's just reversed. If I'm buying a spread, if I'm buying in the market, what do I, generally, what am I saying? that the market's going up, right? If I'm selling, I'm saying the market's going down. If I'm buying, I'm saying it's going to go up. So if I'm buying, I don't make additional money above the ceiling. So if I buy down here, the market goes up, then I can make money up to the ceiling. But if it goes outside of the ceiling and keeps going, I don't make any more money on this spread. But what do we talk about we could do? If I think it's going to keep going, I could look at another spread, right? Above that ceiling. Conversely, I can't lose additional money below the floor. Okay, if I'm buying it, saying it's going up, and I'm wrong and it goes down, I only can lose money to the floor of the spread, to the bottom of the spread, and then I'm protected. And again, I don't get stopped out just because it hits one side or the other. What do I mean by that? Let's say right here. Let's say right here, I bought this spread. I bought into the spread right here because I think it's going up. And as soon as I buy into it, what does it decide to do? Pop down. Raise your hand here. Say yes in the questions box. How many of you have ever entered a trade? I'm going to buy right here because I think the market's going up. How many of you have ever entered a trade and immediately what happens? Boom, flash against you, knocks you out, kicks you out, hits your stop, and you lose money, and you're out. And you're not real happy, right? Like, you're not real happy at all. And then, to make it worse, double whammy, kind of like the market not only stabbed you, but now is going to pour salt in the wound. It goes, hey, you got in thinking we were going up. I shot against you to get you and take all your money. But now to make matters worse, guess what we're going to do? We're going to actually go up exactly like you thought we were. Ha, thanks. Every single one of you have had it happen, haven't you? Then you become a, what do you call it? Then you become a conspiracy theorist, right? They're out to get me. The whole world that trades this worldwide market knew that I got in right here. And they just moved the whole world market down just to get my little bit of money before they went up, right? You start thinking everybody's out to get you, right? So, but if you were trading a spot market, and you bought here and it moved that far against you, that's a big move down. That's that could sustain a pretty good size loss and you want to get out, right? So on a spread, if you bought right here and it comes down and hits your floor, the bottom, do you want it to just close out this trade and forget it? Or are you glad that it doesn't close out the trade? Because you bought here, when it hits the floor, you're at your max loss already, right? You're not losing any more as it goes down, are you? You're not losing anything at all after that. So you're glad that the trade is still open until expiration, because what does it do? It comes back in and goes all the way to the other side and gets you max profit. Makes sense? So do you see how it's a very positive thing that the trade does not automatically close when it hits one side or the other? Because now you can withstand, potentially some of these whipsaws of the market that whip against you and then go in your direction. Does everybody see that? Do you see the power of that? Now, what's the flip side of that though? If I buy right here, let's say, and the market comes all the way up to the ceiling, should I just sit and watch it? Or should I at least consider go ahead and saying I bought way down here or even in the middle, it got all the way to my max profit. Maybe I should close the trade out, right? Now, some of you say, yeah, but if I close it out before expiration, I might have to pay a couple dollars of bid-ask spread. Okay, don't talk to me about a couple dollars of bid-ask spread, because what can happen a few minutes later? Boom, all the way back down. You see that? Or you hold it to expiration, and where does it expire? Right down here, about like 24.85. You see it? Don't get all caught up in, well, but I don't have to pay a couple dollars of bid-ask spread at expiration. So when it gets to max profit, I'm going to hold off because of those couple dollars. Seriously? I mean, let's look at this. So let's say that I bought right here at 24.10. Okay? So again, same example. The floor is where? 2400. What's the difference between 24.10 and 2400? 10 pips, right? So I bought here, say the market's going up. The floor is right here at 2400. It's 10 pips. Each pip is worth $1. My max risk is 10 bucks. So again, when it hits this floor and I'm down that 10 bucks, that's the most I can lose. Doesn't matter if it keeps going down. It's the most I can lose. Okay? But then the market comes back up and it comes all the way back up here. I bought it at 24.10. Okay? There's 90 pips of potential profit up to the ceiling. Okay? Each pip is worth $1. That's $90 of potential profit. If I was able to get in at the bottom of the spread, even in the middle of the spread, let's say I bought in at 24.50. Now it's up close to 2,500. How much of profit would I be at? If I bought at 24.50 and now it's up here at about 2,500, that's 50 pips, right? 50 pips. What do we know that the market can do? Kind of pop around here and then what? Come all the way back. I guarantee you, when you see that market fly all the way back down and you were at max profit, but you didn't close it out because you were worried about a few dollars of bid-ask spread, you'll never do it again. Everybody see that? Okay. So it's a positive thing that it doesn't just auto close you because the market come back in your direction. But when it's in your favor and you're up at max profit, go ahead and consider closing that thing, right? Okay. Mike says, yes, but how does one close it out? Mike, let me show you. Okay. Real simple here. So this is a demo account. And again, this is not a trade recommendation. I'm just going to show you how, how this works. So all right, so let's say that you're on the Nadex platform here, right? You've got indice binaries, indice spreads, forex binaries, forex spreads, okay? You got your different spreads here. And whatever it is you're going to trade, whether it's indice, let's just say forex, okay? Let's say euro dollar. And let's just choose a closer spread here. These spreads were from 1 p.m. to 3 p.m. Notice we've got 3 different spreads here. Let's just say, for example, Mike, that I bought this spread right here. Okay. So I'm going to buy this spread. Okay. So I bought that spread, right, Mike? So I bought, so that means I think the market's going up, right? Again, this is an example. So let's take a look here. So each one of these spreads has a different floor and ceiling. You see that? This is 1460 to 1560. This one up here is 1560 to 1660. This one is 1510 to 1610. Okay? Real quick, you want to learn something neat? because I know the next question one of you is going to ask is, how are these floors and ceilings determined? Who makes these floors and ceilings? Yeah, anybody thinking that? Right? Okay. So I'm going to show you. Okay. Give me a second here. I'm going to pop something up because this is very, very important to know. Okay. And once you see it, you're like, oh, wow, that makes so much sense. And then you'll be able to know pretty much what spreads are going to be available to you in the next upcoming hour. And I'll show you here. Give me a minute to get this other chart opened up here. Give me just a second. Okay, but real quick, while I'm waiting for that to come up, okay? So Mike, so these are the different spreads that are available. Right here we have the offer side and we have the bid side, right? So the offer side is what we can buy that spread for. The bid side is what we can sell the spread for. Make sense? So this particular spread that we bought was the 1510 to 1610. So you see it in our open positions, right? We bought it. Notice right here, position says +1. That means we bought. If we sold, it would say -1. Okay? So we bought this spread right here. So if I buy something, what do I have to do? Okay, so if I buy a spread or even a binary, I have two options. I can hold it until expiration and see what happens, right? But if I want to get out of it early, if I buy something, what do I have to do to get out of it early? I got to sell it, right? Make sense? So this spread right here, where did I buy it at? Well, I bought it, see, +1. Average price shows what I bought it for. I bought it at 1547. Everybody see that? Okay. Notice this thing right here that says current market is 1545. What's the difference between 47 and 45? Who can tell me? It's right there. $2. See my profit loss? -$2. You see it? Okay. Now everybody see this right here, current market, 1545. Now it's 1546. This spread, if I go back and look at that spread on the, on the platform, this is the price that it can be bought for. This is the price that it can be sold for. See that? Notice this price that you can sell for, 1545, is this number right here, 1545. That's the current market. Because see, I bought it, right? So I own it, as it were. I bought it at this price. Well, what's the going rate right now to sell it? 1545. So that's what this is, 1545. So the difference of where I bought, okay, average price, compared to what can I sell it for right now, that determines this profit and loss number. That makes sense? For any of you newbies, does that kind of help explain some of this stuff a little better right here? Make sense? Okay. And then over here, the indicative index, that's just where the indicative is right now. Like, where is the market at? Okay. So if any of you are ever wondering, what is all this? How is it determined? Well, it's determined by the market out here. That spread right now can be bought at this or sold at this. So where did you buy it compared to where can you sell it? Okay, so Mike, back to your original question. How do I get out? Okay, so I bought this spread. Notice it's in my open positions, right? So if I'm going to click on this to exit it, okay, so I can hold this to expiration, right, Mike? And it expires in 1 hour and 19 minutes at 3 p.m. But if I want to get out of it early, I have to sell it. So if it's in my open positions, so Mike, if I click it, it automatically opens a ticket. And notice what's already automatically marked on this ticket: sell. Because that's the only way I can get out of it, right? Okay, and I can open that ticket. It's already marked sell, and I can hit place order. Boom, it's gone. See it? Does that make sense? Let me do it again here, because I want to show you one other thing. So if I buy it, okay, I bought it. It's open, okay? So right now, a couple different things here. Let's say that I buy this spread right here in the middle, 24.50, okay? And the market goes up to 24.80. Now, okay, let me clarify. When I say it goes up to 24.80, what I mean to say by that is I can sell out of it at 24.80. Make sense? And so I buy here at 24.50. Now it's up at 24.80. And I have to go. I got to go to work. I got to go do something with the kid. I can't sit until expiration. So I want to get out now and just lock in my $30 of profit. Yeah, I mean, if it keeps going, I might can make more, but I'm not going to be here. It could go against me. I bought it 24.50. Now it's up at 80. I just want to take my 30 bucks and go, right? Well, then that's what I would do. Exactly what I showed you a minute ago. Of, you know, I've already bought it, so I want to get out of it now. I click it. It opens a ticket marked sell already, and I just place the order and get out. Make sense? Another example. Say I bought right here at 24.50. Okay, little quiz. If I bought right here at 24.50, I bought meaning I think the market's going up. What is the most I can lose if I buy at 24.50? What is the very max loss? 50 bucks, right? Because the most that can go against me is down here to the floor. So if the very most that I can lose is 50 bucks on this trade, how much is Nadex going to put on hold in my account for me to get in this trade? 50 bucks. That makes sense? Because the most I can lose is the amount that Nadex will put on hold. Make sense? So if I buy at 24.50, $50 is going to be put on hold in my account, correct? The market goes up to 24.80 and I close the trade. What am I going to get back into my account? I'm going to get the $50 back into my account that was put on hold. Plus, I'm going to get the $30 profit back into my account minus the fee, right? Make sense? So let's say I buy at 24.50. I've got $50 on hold. Boom, something turns around. My charts and indicators suddenly are telling me something different. Now I bought at 24.50. Now the market's down here at 24.20. Now it's only worth 24.20. How much am I down? I bought at 24.50. Now it's down here, we're 24.20. I'm down 30 bucks. Do I have to just sit here and watch it go all the way down to the floor and lose my whole 50 and let it keep going? If my chart is telling me, hey bro, you're wrong, it's not going short, and I see I'm already down 20 or 30, I can exit it early to not take the full loss. Okay, everybody get that? And it works the same way. If I bought the contract and I'm up in profit and I want to close it early, then I open it, it's already marked sell, and I close it. Or if I bought this contract and I could lose 50 bucks, I'm already down 30, and it looks like the market's still heading down. Does it make any sense just to give up another 20 and say, oh well? No, just close it. So you can close it early for a profit or for a loss. Okay. Mike says you must have someone to trade with. Mike, I'm not sure of your exact question when you say trade with. Do you mean like if you bought it, there's got to be someone out there to sell? Okay, right. Well, Nadex is an exchange, okay? So there are market makers that are making a market, that are providing liquidity in contracts, all right? Plus other traders are out there as well. And somebody's asked a minute ago, Leonard, okay, so we know right here, offer, this is the price we can buy for, right? Bid, that's the price we can sell for, right? Offer size, 112, 120, 100. That's how many contracts are available at that price, okay? All right, I mean, yes, there's other traders out there that are buying and selling, but there's also market makers that are providing all of these contracts to make sure there's contracts available for you, Mike, okay? What is a market maker? A market maker is just a middleman providing liquidity. Notice this. You can buy it for 48, 47. You can sell it for 45. There's a $2 bid-ask spread in that example. What is a bid-ask spread or a bid-offer spread? Well, it's the spread between the bid and offer. It's the difference between the bid and offer. That's a market maker. That's how a market maker makes their money, is they're providing a bunch of contracts out there on each side for you. And what do they get in return? Well, hey, I'll buy a contract from you for $5 and I'll sell it to someone else for $7, and they're going to keep the $2. Like, that's how they make their money. Make sense? Okay. And so, Mike, do you see what I mean? There's a lot of contracts there. Now, what if I said, hey, I bought this for $15.46, and I want to take profit at, I want to make 30 bucks off of it. And I've got to get up from my computer and kind of run back and forth. Okay. What would it need to be at for me to make 30 bucks? If I bought it for $15.46, what do I have to sell it for to make 30 bucks? If I bought it 46, I've got to sell at 76. Okay. Right now, what can I sell it for? At around 44. So notice if I click this and open it, it's already marked sell at the market, which is right now's price of like 45. I don't want to do that, do I? I don't want to sell it till it's at 76. So instead of saying execute this sell right now at the market, I click this right here and I say limit order, sell it at when it gets to 76. See, I changed that, and place order. Now all of a sudden, what do you see? We had an open order here, which is still open. We bought it. There's a working order sitting in there, negative one, to sell at 1576. So I've set a take profit order. You see that? I've set a take profit order so that when that current market price, when it reaches that 76, boom, it'll execute and close both these trades out and take my profit. You see that? That makes sense? Okay. Okay, let's see here. I'm running way over, but I promised I would show y'all one thing. So give me a second here to open a chart. Let's see here. Mike Man says crystal ball for working order. Mike, are you saying, hey, crystal ball to know where to place that at? Is that what you mean? Well, I'm just saying, like an example, let's just say on this particular screenshot here, Mike, let's say that I bought at 24.30. Okay. So what am I risking, Mike? 30 bucks, right? And let's say that I've got to leave. I can't be in front of my chart to monitor this trade. Okay. So I think the market's going up. I bought at 24.30. So I've got 30 bucks at risk. I want to go for a 1-to-1 risk reward ratio. So if I'm risking 30, I want to make 30. So I place my limit working order for 30 higher, and then I walk away. Does that make sense? As one example of how you would use that and come up with a number, not necessarily a crystal ball number, but for a reason why you would select a number. Or let's say, hey, maybe I'm back and forth to monitor this trade. I bought right here at 24.30, Mike, but my chart and my strategy and system tell me that up here around 24.70, there's some support resistance line, deviation line, some strong levels that we might fight getting past. I don't want to sit through all that. So I want to get out, like, I see all that possible resistance at about 24.70. I'm just going to put my take profit at 24.65. Trying to ride that up and get out right before all that choppy mess might hit. That makes sense as well. Just a couple examples of, ways you might come up ahead of time with a predetermined number for your take profit. As a, normally you would, watch your trade and monitor your trade and trail your stop and, do what the market and the chart's telling you to do to get out. But that's a couple of reasons there why you might just want to do that. A lot of people operate on like a 1-to-1 ratio, and so that's my risk. Boom, that's my take profit. Okay. Let's see here. Yes, KM. Yep. The leading pair, you're going long on that pair, as it were. Okay. So, can you change the value of the pip field? Kenneth, no, you cannot, but let me show you. Okay. Each spread is worth $1. Oh, by the way, somebody asked earlier, working order. Let's say, hey, I made it back and I'm going to be able to monitor this trade. I think it's going to go far. I don't want to exit at that take profit anymore. Well, my working order, I just click it and it opens the working order. I can change it to something different and amend it. or I can just delete the whole thing and it's out of there. There's no more working order. My open order is still there. Okay. Let's see here. So, Kenneth, you cannot change the pip value. Each spread is worth $1 per pip, always, ever. That's it. But, Kenneth, look how many spreads are available on this particular one, 120. Okay. So, if I'm going to buy a spread, I can buy 10 of them, right? Then it's what? $10 a pip. See what I mean? Okay. So you can't change the pip amount, but you can change the number of contracts if you want to make more per pip. Okay. When closing out an open order, well, when you're closing out an open one, yeah, you just click on it and open it, and then you just do place order. Okay. And if it's a market, if you have a market order selected, it's going to get you out of this current market. If you say limit order and you put a limit in of, hey, get me out, but only get me out at this price or better. Okay. But yeah, if you just did a market order, all right, let me start over here. You click it. And if it was market order, that's basically saying just get me out now, place order, boom, everything's gone. Okay. All right. So, real quick here, just as an example. Okay, guys, this is not a perfect example. I don't even have the proper charts up that I wanted to show you here, but I want to let you know something. I've kept you so long. Chip's probably looking for me here, but I've kept you so long here that I'm going to keep you another 3 minutes so I can just show you this live. Right now it's about 1:57 p.m. Okay, I want to see what you see this live. These particular spreads right here, these are 2-hour spreads, right? This one opened at 12 noon, expires at 2 p.m. This one opened at 1 p.m., expires 2 hours later at 3 p.m. What do you think is going to happen here in a couple of minutes at 2 p.m.? There's going to be a new spread that goes 2 to 4, right? Okay. How do we know what those floor and ceilings are going to be? Okay. Let's see here. 1543. I want somebody to remember this number. 1540 to 1640. Okay. 1540, 1640. Think y'all remember that? Okay. Where is the market at? So we've got some new, look at these spreads right here. 1460 to 1560. 1510 to 1610. Oh, and 1560 to 1660. Okay, notice those are all 100 pips, right? What is this right here? 1460 to 1560. So we've got a bottom of 1460 and a top at 1560, right? You see that? Then let's jump up here. We have a bottom at 1560. So basically what we've got is 1560 on each side right here, don't we? So we got 1560 going down 100 pips. We've got 1560 going up 100 pips. And then what do we have in the middle here? 1510 to 1610. Who can tell me what's right in the middle between 1510 and 1610? What number would be right in the middle? 1560. Does that make sense at all? It's like this. At the top of the hour, when there's about to be a new 2-hour spread, some people think, oh, well, someone randomly just determines these floor and ceilings, or someone, it depends on if the market's going long or short. It has nothing to do with that. If a new spread's going to open up at 2 p.m., right before 2 p.m., like 2 minutes before, wherever the market is, there's going to be a spread that starts there, goes up 100 pips. Another spread that starts at that same place, goes down 100 pips. I'm not actually drawing out 100 here. Then there's going to be one right in the middle that goes like this. Up 50 and down 50 when the market's right there. Does that make sense? On this particular market that has 100 pip wide spreads, like every market's a little different, but you'll always know pretty much where that's going to be. So if I go back, where's the market been at? Around like the 1540 range, right? So I'm going to refresh because we're after 2 o'clock now. So let's go to forex spreads. Let's go euro dollar. Oh, you know what? I'm so wrong. I'm sorry. Yep, because there's actually not one that goes 2 to 4. I'm sorry. Let's see here. Yep, I'm sorry. There's not one that goes 2 to 4 because those close at 3 o'clock. But does that make sense how that works? Okay. Whatever the market is right there when it's about to open, you've got that as the floor of one ceiling, the floor of one spread, the ceiling of another spread, and then they pop one right in the middle. Okay, so, all right, guys, we have gone over, we've gone a little bit over here. Sorry about that. Real quick, Kenneth says, if you open more than one spread, does all the spreads show on one screen so you can see all your spread? Yes, sir, absolutely. Like if you go right here, Kenneth, and then I'm going to shut us down here. If I go and I say, yeah, give me the spread right here. I want to buy one of these, okay? And then, so it's right there. You see that, Kenneth? And it says +1. You see that? Oh man, the market's really moving. It's really going to go my direction. I think I want to add more contracts onto this. I think I'm going to buy 5 more. I buy 5 more, process it, boom. Now it says +6. See that? Now, average price. It's going to average the price that I paid for all 6. So if the first one I bought at, X amount, and then 5 more I bought a little higher, then it's just going to average them all to say, what is the average price? But yep, they're all right there together. Okay. Chart, how do you chart the trade with C? RD, it all depends on what charts you're using. Okay. I mean, here at Apex, we use NinjaTrader charts, with all of our proprietary stuff. And, I kind of just draw it on there myself, but you don't necessarily have to have it drawn on there. You'll just, you're monitoring and knowing exactly where you are and what you're doing there. So, well, guys, thank you so much. Y'all have been a great crowd. I appreciate all the questions and the input. I hope this was helpful to you. I hope for any of you that are, we're brand new to spreads, this is kind of an eye-opener for you and gives you a much better understanding of spreads. So make sure to hop on over to nadex.com and get signed up for tomorrow's webinar. I'm doing a webinar tomorrow about truly understanding risk reward with Nadex Spreads. You kind of got the basics today. Tomorrow I want to cover some of the kind of top misconceptions about spreads and making sure you really understand risk reward, how to actually manage your trades. Okay. Thanks for your time, guys. I appreciate it. We will see you tomorrow. Have a great one.